Malaysia Airports Holdings is planning to slash its capital expenditure by more than 80% as it embarks on an aggressive cost optimization plan. From its original 1.8 billion ringgit allocation, MAHB is now earmarking just 320 million for capex. Group CEO Datuk Muhammad Shukri Muhammad Saleh says the bulk of the original capex allocation comprised airport expansion and other projects under the regulated asset-based framework, which have been put on hold in light of the coronavirus crisis. He says this allows MAHB to go back to basics and focus on 6 critical areas that need spending, such as end-to-end baggage handling system upgrade, replacement of aerotrains, and commercial reset. Shukri adds that MAHB also managed to reduce its operating costs by 20% thanks to its cost optimization plan, which he said tentatively would run for around 18 months. Going forward, Shukri says the airport operator is also weighing several options to improve liquidity as COVID-19 continues to badly hurt business. Among the options include an untapped sukuk facility of 1.5 billion and an additional credit facility of 1.7 billion. Former 1MDB CEO Datuk Sharul Azral Ibrahim Helmi agreed that certain documents involving the restructuring exercises to repatriate the fund's $2.22 billion were phrased to deceive its board. Lead Defence Counsel Tan Sri Muhammad Shafi Abdullah alluded this during cross-examination today that the director's circular resolution related to the Petro-Saudi deal was worded in such a way to make it difficult for the board members to understand the processes involved. While Sharul agreed, he denied that he was part of the discussion, saying that it only involved fugitive Low-Tech Joe, former 1MDB legal officer Jasmine Lu Ai Swan, and officials from Petro-Saudi International. He believed, though, that Low was conveying the wishes of then Finance Minister Datuk Sri Najib Razak through MOF Inc. It came out today that Low wanted to prevent the board from finding out that the company's overseas investment only had paper value and could not be brought back to the country. S&P Global Ratings has revised its outlook on 5 Malaysian banks to negative from stable. The 5 banks are Maybank, CIMB, Public Bank, RHB and AmBank. In a statement, S&P said the ratings actions on these banks were based on the outlook revision on the sovereign credit ratings on Malaysia. It affirmed its A- long-term and A2 short-term issuer credit ratings on Maybank, CIMB and Public Bank, and its BBB plus long-term and A2 short-term issuer credit ratings on RHB and AmBank. On June 26, S&P had revised its outlook to negative on the foreign currency and local currency long-term sovereign credit ratings on Malaysia due to additional downside risks to the government's fiscal metrics given the weak global economic climate and heightened policy uncertainty. S&P says it expects the banking sector's non-performing loan ratio and credit costs to increase to 2.8% of total loans and 66 BPS of gross loans by the end of 2020. However, on a positive note, S&P believes the bank's solid capital buffers are important mitigants that could partially offset unexpected credit losses from the transitory but acute COVID-19 economic shock. CIMB Group Holdings Chairman Dato' Muhammad Nasir Ahmad says the group remains resilient and well capitalised to withstand negative shocks from the COVID-19 pandemic. In a statement today issued in conjunction with CIMB's first virtual annual general meeting, Muhammad Nasir said the group remains focused on capital optimisation and strategic initiatives under its midterm strategy Forward 23. He said the group will also continue to be prudent in its credit underwriting approach to achieve the right balance between profitability and growth. Muhammad Nasir adds that the board looks forward to working with new group CEO Dato' Abdul Rahman Ahmad to navigate the urgent challenges amidst the rapidly changing banking and economic landscape. Given the COVID-19 pandemic and stress it has placed on the global economy, CIMB expects its financial performance for financial year ending December 31st, 2020 will inevitably be affected. To mitigate this, the group will review its Forward 23 strategy as well as step up its cost management initiatives. Alamodome Resources saw its first quarter net loss widen to 23.5 million compared with the 4.4 million net loss clocked in the first quarter of FY19. The drop came from a mix of impairment on vessels and softer performance of its segments. Its offshore support vessel business worsened by 242% as the number of charter contracts decreased. In marked contrast, its revenue skyrocketed 280% to 104.4 million compared with 27.6 million previously. This was the result of revenue derived from the group's subsea services, offshore installation and construction segment coming in 1,626.4% higher than the year before. On its prospects, Alamodome says its outlook is influenced by the level of capital expenditure spending by oil majors. In its notes to the bourse, the group says that Petronas is keeping its prudent view on the industry outlook and will respond with cautious optimism, particularly on new projects.